Riker Fuller is going to be buying his first investment property when he's 10 years old. You heard it, 10. Stay tuned for this episode with his dad, Kyle Fuller, with Factum Financial, who is an infinite banking expert, who's going to talk through some important words that I think you need to be aware of. Number one is sequence in investing, and find out how Kyle, every time he puts $1 into his current investment that he started years ago, it actually gives him back $1.63. It's pretty impressive. And then also understand the velocity of money from a different perspective than you as a loan officer or realtor who's ever listening to this may know. The bottom line is this, is that this is going to be an eye-opening opportunity for you to hear about something you've heard about before, but maybe look at it from a little different perspective and a little different light. This is a great episode. I'm so glad you're here. Welcome everyone to another episode of the LO Mastermind. I am Todd Bookspan, and I am so excited that you are here. We come together every Friday live to educate you, inspire you, and sometimes make you tougher. And that's what today is all about. I've got a really good friend and mentor of mine here, someone that I'm a client of Kyle's, Fuller's, and I am also a fan of Kyle. But before I bring Kyle on, of course, I got to bring on my co-hostess, Deborah Byrd. Welcome, Deborah, who's also dressed up wearing a Factum Financial shirt today, representing as a client of Factum Financial.
That's because I'm a real client and a super fan of Kyle and his entire business, his business model. Like you guys, everything you do, from the birthday cards to my kiddos, like they love opening those. We all have shirts, and so we're super fans. Todd, beat that.
Well, I don't know that I can, but all right, Dave, welcome. I love the new audio and visual setup of your home office up there in Oregon.
Yeah, thanks, brother. Yeah, no, I'm pumped to learn from Kyle. The way I would frame today's call, guys, because I'm learning from Kyle too. I'm just meeting him and learning what he does. But the loan officer of the future is not a loan officer. They're a mortgage advisor, and a mortgage advisor understands money and understands money so well that they can teach people how to not just achieve home ownership, but achieve home ownership with financial freedom. I do want to remind folks, First Home IQ had a really big week. Make sure you check out my post this week on LinkedIn. We had a big release. There was an article in Housing Wire where we're helping first-time home buyers be inspired, be educated, go from overwhelmed and confused to confident. So check out what's happening with First Home IQ. But Todd, let's bring Kyle on and let's learn how to be more financially literate.
Yeah, I would say this. So Kyle Fuller is the CEO, founder of Factum Financial. He's based out of Arizona, but advises all over the country. There's a lot of things that make Kyle unique, but I met Kyle because he's the person that we all aspire to be. He's the one who said, hey, you're pretty far off in life, Todd. Let me take you to lunch. And so Kyle's taken people over the years to lunch. And years ago, he took someone in the dental field to lunch who changed his life, opened him up to the idea of infinite banking. And a lot of you in the mortgage business have heard of infinite banking. Some of you have researched it. Some of you have not. Some of you have said, oh, that seems like a great idea, but never executed on it. Some of you thought maybe that wasn't the best idea for you. But here you are. You've got two of the three hosts here who are clients of Factum Financial. My 4-month-old grandson, he's kind of late. It took my daughter a bit to fill out the paperwork, but my new grandson is now a client of Factum Financial. And so I believe in it so much that I actually am doing it for the next generation of the Bookspans. And the bottom line is Kyle is the person that Keller Williams has brought in to teach in their market centers all over the country how to have tough money. So when we talk about this infinite banking thing, it goes beyond that. It goes really more around how do you, as a loan advisor for yourself, most importantly, and then also for your clients, really understand money in a different direction. So welcome, Kyle. Let's talk about tough money.
Thanks for having me, Todd, Deborah, Dave. It's an honor to be on here. I've seen all of you all over social media. I love all the good things you're doing with education and coaching and just, bettering the industry overall. And so it's an honor to be here. And if it's okay with you, if I have your permission, I'd love to share a few ideas around some concepts and models and systems that I built and I practice in my own life that Keller Williams is usually using now and clients all over the country are benefiting from. Is it okay if I share my screen?
Please do.
All right, let's do this. So I want to start with one idea, Todd. And you mentioned you and I went to lunch a number of years ago. And I love lunch appointments. I think it's one of the greatest ways to connect with people. A lot of times when I'm telling people what I do for business, really what I do is I go to lunch with amazing people. We eat really good food and we talk about amazing ideas. And you can build a rock business just by taking more people to lunch and networking with them. And hopefully everyone that's on the call today that's in your industry is utilizing that. Go out and connect with people. I think people are starving for that one-on-one connection in our age of social media and technology. And what I have found, Todd, is over the years, if people could articulate what they really want out of life, it's this image we're looking at the screen here, which is, it's got 5 key areas of life on here: spiritual, personal, family, financial, and occupation. And I think the people that are really winning in life have excellence or abundance in all of these areas. So they wake up every day, they enjoy what they do for an occupation, they're winning financially. And the only reason I think people want to win financially is so they can go out and fund the other areas of life. I know, Deborah, you got a team of athletes over there in the Byrd family. It requires money to feed all those athletes, but I can promise you, I don't even have to ask, but I know how much that lights you up as a mother to see your kids on the field playing and being competitive. And all of these things take resources to go fulfill those dreams and ambitions. And so the only reason I really care to talk about money in the first place is so that you can use it to go fund the spiritual area of your life, the family vacations. I got an orange Lamborghini right here behind me that sits on my desk that a client gave me. That's on my list. I will have that car when my passive income is per month what that thing costs. And so that's kind of the treat for it. So it's okay to have those nice things, right? And when you talk about money, there are levels to this wealth game. Now, we call this image right here our tough money levels. And the way we've kind of framed this model is there's 4 essential levels to the money game. 100,000 or less in net worth, people that are 100,000 to a million in net worth, people who are 1 million to 10 million, we call that level 3. And level 4 is anything over $10 million of net worth. Now, I'm assuming everyone that's listening to this, we're all at a certain starting point, and everyone wants more in the financial area of life. It's just a given. I've never met one person that's like, no, I actually wish I had less. Everyone wants more in the financial area, and understanding a few key things on your wealth plan will give you all the clues on what to do next. And so one of the keys to accelerating in the wealth area of life is understanding where you're currently at. So let's assume, Todd, we have this top 10% American family. This is a family in America that makes about $150,000 a year, which is like a top 10% income in the United States. And they have a net worth of $840,000. So we'd classify them as a level 2 wealth family. Now, they might say, Deborah, Dave, Todd, I'm coming, to your mortgage summits and I'm learning how to be a better loan officer. And my target net worth is $3 million, because at $3 million, if my net worth was there, we'd have enough passive income to live the life we've always wanted. Now, one of the other clues that they're going to need to zero in on is what's their cash position, their liquid net worth. And this is a very important number to their wealth building plan. And everything you're looking at here on the screen are actually huge clues that'll tell every listener today exactly what is the next best wealth step you can make. Now, let me know if this next image resonates with you all. So a lot of times I get to hear from gentlemen worth $100 million or phenomenal, female leaders in the industry that are way, way wealthier than I am. And sometimes you hear these people talk from stage and you're like, okay, it's time to buy a golf course, Todd. And we need to sell off 40 single family rentals to go buy the $10 million golf course. You know who I'm talking about.
I do.
And after they're done speaking, this is what my head feels like when I was building out my wealth plan. And I got 40 things on the screen right here, from estate planning, investing, legacy plan, debt payoff, infinite banking, auto insurance. There's all these things, and it feels like this massive junk drawer that we're just kind of reaching in and being like, I guess I'll focus on estate planning this year, right? And sometimes when you hear certain people talk about wealth, if they're outside your wealth level, if you follow exactly what they're doing, you're going to spin your wheels and you waste time, energy, and resources. And the reason I'm showing you this today is what the Tough Money curriculum we built at Factum takes all of these things and it puts it into a sequence and a system that'll help you focus on exactly what you should be doing at your current wealth level. And if you have a roadmap like this, you will go so much further, so much faster with way less risk. And that's essentially what I build for people, these plans to get them from where they're currently at to where they want to go in less time and less risk. And so before we go any further, I'd love to know any questions so far. Did that resonate with the three of you? seeing that model and system?
Yeah, a couple of things. First, I want to push the audience, ask questions, like put them in chat as we go, as you have questions. Also, when you're taking notes, like, my first kind of note to self is just how important it is as a mortgage professional to ask questions beyond the transaction. Like every loan officer asks, hey, how long do you think you'll be in this home? And that's your big financial planning conversation, and based off of that, I'm either going to recommend a 5-year arm, a 3-year arm, a 30-year fixed. I talk a lot about asking people, how old do you want to be when you're debt free and your home's paid off? Kyle had something here, like, what is your goal for your net worth? Like, where do you want to be? So if you get nothing else from today, the push is to have a conversation with the consumers you serve beyond the transaction. The questions alone will differentiate you, but the answers to those questions are going to give you the ability to have a much more powerful relationship with that consumer. So like, we could stop right now, and I hope that's a takeaway for everyone. And again, put questions in chat as we go.
Yeah, I got a couple of thoughts. Number one is, you're saying for the people that are level one, less than 100,000, right? You're talking about savings in environment, savings strategy, right? And liquidity, we know, is so important, right? Those of you who've been in the business like me since the financial crisis, people lost homes because they didn't have the money to make the payment. We've all seen that. The people who pay off their house and then don't have two nickels to rub together if they skip a paycheck of some kind or have some big expense. So I do love the fact that you're teaching people to be tough. You got to start saving. And then the next level, you're talking about insurance, and really you're talking about making sure that you're protected. Tax strategy, financial banking, that's where you've got infinite banking in there, debt strategies, before you get up into more of the advanced stuff. One other thing I want to give a shout out to, one of our friends and mentors, Brett Tanner. He runs a group called Be Wealthy. He also runs KW Wealth, if you happen to be a Keller Williams real estate agent who's listening. And I've been a member of both groups now for, a long time. And I see Kyle there when I go. Brett has a great podcast called the Be Wealthy Podcast, and he's got a mastermind that he's been talking about. And his mastermind is really for anyone who's thinking about, how do I actually invest at a higher level? I know his next mastermind is going to all be about his shift from residential real estate to commercial real estate, which is what Kyle alluded to a few minutes ago. Brett did recently buy a golf course. It's 100 units plus a golf course. And so that's a great opportunity. Josh Metal is part of that group with me, and it's a lot of fun. So I love it. I think this is really great. If you're listening to this, you might want to go over to the Win by Noon YouTube channel and watch this part, just because you're going to see so much.
No questions for me. I'm ready to keep going, Kyle.
Deborah's ready. Now, Todd, so I just taught a class online with my 8-year-old son. He's my oldest, Riker. And so there's very specific things you focus on in each one of these levels. And I'd love to ask you, because I know that you guys are all big over here on empowering the next generation through education, financial stewardship. Can you briefly remind me, update me on some of the things that you're doing with your movement over there on that? Because I'd love to collaborate with you. I think I'm teaching the same stuff to my kids, and the things that we focus on at that early in life is developing their skills, teaching them how to save, how much to save, where to save. Those are the best things that they can learn in the level one wealth game.
Yeah, no doubt. So you wanted to hear a little bit more about First Home IQ. Is that the question? Okay. Actually, if you don't mind, let me share my screen.
Why don't you pull down for one sec, Kyle, and let Dave share the new website.
Yeah. So let's go. First Home IQ.
There we go.
All right. So what I am going to show is the new ambassador page, where we're turning the loan officer into the guide for a consumer. And while First Home IQ is dedicated to getting more next gen consumers into homeownership, like any age, I don't care whether someone's in their 30s, it's helping them create a plan, making you the guide, making you think about home ownership. And then if you are an actual ambassador of Mortgage Coach, it's got some lead magnets, some places where if the consumer takes a quiz, like down here at the bottom, if they want to take a home buyer IQ test, it's 15 questions, it's free, takes a few minutes, you're going to capture an email address. It's got a guide. You could email it or you can open it. You'll notice that it's got your name where it says Dave Savage. This would be your name as a loan officer. And Kyle, just real big picture, like the number of people in America that are mortgage ready that could buy a home, it's millions. And why are they not buying homes? In many cases, they're mortgage ready, they could, they should, but they don't know what down payment they need. There's still a misconception that people need 20% down. They don't know, they have misconceptions around credit, they have misconceptions around qualifying. So our mission is to just make sure everybody in America understands the homeownership game. Like, it is the wealth gap in America, who owns versus who rents, and to get people into homeownership younger and faster. And most of the content we're teaching is basic financial literacy content and homeownership ready content. We're not getting into advanced strategies like yours.
Okay, I love that. Education's always the key. And I'll
Yeah.
tell you that I got young kids, but the earlier you start talking to your kids about money, even just the language and lingo of money, they are substantially better off. So the goal is my little guy who's 8, by the time he's 10, will be buying his first property. And so we got 2 years. We just went over his net worth, all of his stuff on this class a couple weeks ago. So I love what you all are doing over there, and we should collaborate.
Yeah, we would love to have you in the community. And Todd will why don't we set him up as a honorary ambassador, Todd, and then you can figure out whether you ever want to donate financially or just be aware of the content. And again, anybody, I'll put a link in chat to my post on LinkedIn the other day. And that LinkedIn post has a link to the Housing Wire article that posted on Wednesday. So my ask to everybody, read it and share it with your mortgage friends and give it a like if you like it.
Yeah, I'll make sure that I also we'll get that in the show notes. Those of you watching this on YouTube or listening to on a podcast form, we'll have links down below to that, as well as I love the video, Kyle, that you did with Riker walking through his journey to get to, he's worth his, I'm not going to spoil it. He's got a pretty good net worth. He's already making some private loan out there. You're taking advantage of the tax strategies that are available to you as a business owner to employ your kid. I saw the pictures of him taking trash out to the dumpster. I mean, you're putting him to work. You're not just giving him money. And I'm looking forward to having those same conversations with my grandson. I wasn't smart enough to do this. I read the book that's behind you, Become Your Own Banker by Nelson Nash, years and years ago. And I just wasn't smart enough to execute it on a small level. And had I done that small level of execution, my personal net worth and my personal journey would be further ahead. And it's been pretty good. I'm not complaining, but I definitely could have benefited from jumping in sooner. So I'm excited for you to walk us through the next steps here.
All right, let's do it. Let's continue on. All right, so what is the next best wealth move? It depends on a few of those clues, like I said. Net worth, income, liquid net worth. These are all clues that'll tell you exactly what to do next financially. Now, some of the ideas I want to share with you come from a curriculum that we call our Tough Money Experience. So this is a class that we teach. We're teaching it to a lot of Keller Williams market centers nationwide right now. And the 3 ideas I would bring to each one of you and your families or your businesses to help you accomplish your wealth goals in less time with less risk are these 3 ideas we're looking at on the screen right here. Idea number 1 is what we call the inconvenient truth. The reality is no one is coming to save us financially. And the sooner you come to that realization, like you said, Dave, we got to focus on education. We have to understand certain numbers in our business. There's no one that can do that part for us. And these are all habits. And so the question that would help us answer is, why do my habits affect my wealth plan? And I think once people see the math behind this, and we built a whole workbook to help people go through this for themselves, this is costing most people hundreds of thousands, if not millions of dollars to not tweak and alter some of their habits around wealth building. And like you said, Todd, the earlier you do it, the greater the compound effect is there. Idea number 2, we call the problem. And this is a problem that actually an orthodontist, like you were talking about earlier, Todd, he exposed this to me in this idea, and it completely changed my paradigm around money forever. And the question that it'll help you answer is, how does banking affect my wealth plan? We're going to talk about that for a couple minutes today. All of us on this call are employees, self-employed individuals, business owners, or investors. And all of us have gotten pretty good at the skill set of creating new money in our lives. But you see, bankers focus on controlling dollars permanently in their world. It's a very different function of the money game. And once you see this, you'll never be able to unsee it ever again. And then idea number 3 that I would bring to the table to help someone financially is what we call the toughest asset. There is an asset that if you put at your foundation of your wealth plan, you will have more advantages and more certainty than anything I have found. And we look every single day. So what is the foundation of my wealth plan? So let's jump in real quick to idea number 1. And this is a model and a framework we actually got from Gary Keller. He calls this his path of money. This is our version of this. But I think it takes a really unique genius to take a complex subject like money and condense it down to there's only 4 things you can do with money as it's flown into your life. You can spend it, you can donate it, you can hold it, which is another word for save money, and then you can invest it. And hopefully we're investing into assets or investments that lower your taxes, appreciate in value over time, and reduce your taxes, and create cash flow. And so that asset investment is real estate. And we're big advocates of real estate over here. And so if we understand this path of money, part of this is how do my habits affect my wealth plan? Well, you got to know, like, what is your income? What is your liquidity position? What's your investment equity, which that would equal your net worth? The money that you have available as cash and in your investments create what's called your net worth. Now, understanding that simple model and a framework will give you so much clarity and confidence on your financial situation. And Todd, I've been spending the last several months teaching my 8-year-old this exact framework right here. So he's starting to get accustomed to how does money move through my life? What is my net worth? And I think the earlier you can teach those kids, your clients, whoever it is in your world that you care about, the better off they're going to be financially just by having a simple model and a framework to follow. All right.
I'm throwing the link down here for those of you who are on live to the video of Kyle with his son Riker, and then we'll make sure it's in the show notes for the rest of you.
I love it. Thank you, Todd. So getting the proper habits in place around your financial plan will give you what's called the tough money effect. So everyone's ability to thrive financially over time will be dictated by how tough is your money. So these events are going to happen in our life, and events can take many different forms. This could be a death, a divorce, a lawsuit, an accident, a recession. And so you referenced 2008 earlier, Todd. That is a correct assumption. And so you know how expensive it is to raise 11 kids and run a business and put money away? And they did this for 10 years, and they got overextended when the event of 2000 came along. And it basically took my parents from almost being able to retire to near bankruptcy in about 6 months. Now, that's not a fun time as a family. I was 19 when this was going on. Now, here's what's interesting. Families in the Phoenix area that survived 2008, everyone kind of got hit a little bit. But the prices of real estate in 2010, 11, and 12 went to rock bottom, and families created fortunes during the same event where our family was experiencing a lot of pain and discomfort. And the difference is one family had really tough money habits, the other did not, and it made all of the difference. Now, what's unique about these is these big events, they come every 5, 7, and 10 years. So if you're ready for them, you don't look at like, oh no, COVID's here. What do we do? COVID was a massive opportunity to generate a lot of money for a lot of families, but it also put a lot of businesses out as well. And so the question we should answer is, are we tough enough with our habits to not only survive, but thrive through those events? Any thoughts on this before we jump to the next idea?
I mean, I saw this obviously being in Phoenix in the market, right? I had a negative net worth of almost $1 million because I had 5 houses that were underwater. Thankfully, I still own those houses, and now they've got a positive 7-figure net worth, equity in those. Ultimately, I was just fortunate my tenants kept paying rent because I wasn't tough on money. I liquidated 401ks. We liquidated everything. We were down to literally credit card where I'd be like, honey, we got $200 on this one, and we got $300 left on this one for groceries, for everything we need for, 10 more days until I get paid again. And so, I wasn't set up for tough money, although I was aware of the strategies and had someone ironically set up the wrong strategies for me that I couldn't afford during that time. And that's what I love about how you at Factum set people up for success by doing it the right way. I won't spoil the future of this conversation, but I think in the end, this is why you start off with savings and saving strategies. And that's why Gary Keller talks about that in the model that you just showed as kind of that level number one, is how do you become tough to weather the times? And I think we see that with loan officers now. And I think Dave and Deborah, you can talk about it too. We got loan officers who were fat and happy 3 years ago who have spent everything because they didn't create tough money with the cash that they got from loans falling out of the sky during COVID, versus others who actually use that money in a different way. Some may say more wisely. I just feel like, in the end, we did what we did and we got what we got.
I feel like this is why it's so important. The earlier you can teach your kids this and develop those habits, you don't have to then untrain and retrain future behaviors, because, even those who win the lottery, like, you don't see them, we blow it, we spend it, we become emotional. And so I don't know, Kyle, if you've seen, now that everything is so digital and like people don't even look at their bank statements as much anymore, like, do you feel like there's a big miss of just even knowing how money is flowing, because they're not even really looking at, oh, I have this many subscription coming through and I pay for this many ad blocking services and, whatnot, that they don't even have control or awareness of those 4 different buckets of where the money can go.
Oh, absolutely. And Deborah, would you agree that the skill set of making money is very different than the skill set of keeping money?
Yes. 100%.
Like, those do not necessarily translate. Some of us get really good at the skill set of making money, but we were never taught the proper way to keep it, and especially not permanently keep it. And so it's an interesting paradigm to go there. And I'll tell you a quick story, because obviously I teach this for a living. And so I better be pretty good with money myself if I'm going to go out and teach all of these people. And I have this coach I'm working with, and this guy's worth well over $100 million. And he was saying, hey, Kyle, it's great you're saving X percentage of your income. But what I want you to do is I want you to print off your bank statements for the last 90 days, get a highlighter, and you're going to go in there and find everything. At first I was like, I let my ego get in the way. And I'm like, no offense, but I teach this for a living. Like, I'm pretty good at this. And I've spent a decade building this skill set, and sure enough, but I'm coachable. So I do it. I print off the bank statement, and you wouldn't believe the stuff I was finding. And I'm like, I thought we canceled this subscription. Why do we have 2 of these going on? And they're all, most of the time it's smaller stuff, but that small stuff adds up, and you want to be as sharp as you can with this. And so now every month it takes me 10 minutes. I print off the bank statements personally. I do it for a couple businesses we have. And it only takes us 10 minutes, but we are closer to our money than ever by having that like physical interaction with it, not just relying on, I hope everything's okay, we're just going to check it digitally. The closer you can get to your money, the tougher you'll be financially.
Hey, Kyle, let's pause. If you could stop sharing your screen real quick and have a little fireside chat here around rhythms. Todd, Mr. Win by Noon. I'm really good at winning my morning, winning by 7. I have lived most of my life where I'm in that camp, really know how to make money, haven't always been the best at investing and saving money, definitely better at the making it. And I'd really like to have you and Todd go back and forth, because you're clearly a leader at this and killing it. Go back and forth on what are the rhythms, daily, weekly, and monthly, for someone that's a good investor. And I'm going to listen to you two, let you two go back and forth until you've kind of netted it out. But I think it would be just great for everyone to hear you two talk about it and get some takeaways on the daily, monthly, weekly, monthly rhythms. And maybe it isn't daily, maybe it's just monthly, but why don't you go first, Kyle, and then Todd, rock it out.
That's a great question, Dave. And, I kind of look at it, I like the monthly rhythm of finding out what's going on. I think there is a level where you can get too obsessed to where you're spending too much time tracking things daily. And some things just don't need to be tracked daily. It would be just a huge distraction. So what I have found, if you can do it monthly, you grab your P&L, your bank statements, whether it's 3 sheets or 15 sheets, and you get a highlighter and you just scroll through it real quick. And you're just looking for stuff that jumps out at you. Did we really spend this much on marketing last month? I thought we canceled this other subscription.
We need to add to that bucket.
Did we really only spend this much on marketing when we should have spent twice that, right? And so it's all about getting closer to your money. But those habits, the sooner you can get to that, there is a compound effect, but you have to have the right sequence. Once you get the habits down, and you understand how to control it, and you get that controlled money or that savings in the right environment, all of this goes to work for you 24/7. And it'll make you a better business owner. It'll make you a better investor. And I'm not the guy to talk to about acceleration of wealth and investing. KW brought our company in to teach everyone how to be much tougher with the foundational pieces. And that would involve like savings, money management, and where to store what we call the hold category of your wealth.
Cool.
So
Thank you for
I
that.
like a monthly rhythm there. I think that's plenty.
You know,
Cool.
it's funny. It's funny. I agree. So there's a couple things I'll throw out there. The most important word that Kyle said, and it's the word that has resonated with me since I heard it with regards to wealth, is sequence. Is that the problem is that if you're a bit like me, you're all about what can I buy today that's going to go up 10x by tomorrow versus playing the low slong and for me, I think that's where most people, including myself, get it wrong, is that we're actually not building a strong foundation before we're doing the other things. I benefited from buying single family homes early before the crash, held them through the crash, but I would have been way better off using Kyle's tough money strategies before the crash and then actually buying the homes after the crash. My sequence was off, and I luckily made it through it, where I have a lot of friends who didn't. And so sequence is really important. My rhythm, it used to be a weekly rhythm. I spent too much time. When I joined Be Wealthy with Brett Tanner, actually had to do a spreadsheet that how I could be worth $50 million in 30 years. The crazy part is, if you actually figure out what are my investing strategies going to look like, even with conservative numbers, most of you actually could get there in 30 years. In fact, the number may be a lot bigger than 50 million, which sounds really scary, but it's true. And so what Brett taught me was the habit of a monthly. I used to do it annually, maybe quarterly, look at my net worth by category, but I look at it monthly. I'm not looking at my accounts every day. That's too extreme, like Kyle said. I use an app called Kubera. I'll throw it in the link. They don't do a referral link, but if you say you were referred by me as a current member of Kubera to track your net worth, then they will give you something for free. I forgot what it is, and then they give me an extension on my membership. But I use that now because it tracks everything for me. There's a few things I add to it manually, but it hooks into everything. And then I'm a super nerd. I've got Claude Code hooked into it, and Claude Code's analyzing it, tell me what went up and what went down, and where I've got too much risk and too little risk. I've got using it as a thought partner, but not to make my decisions for me. But I actually have had QuickBooks for over 20 years. I can tell you literally 20 years ago how much I spent per month on fuel in my car, how much I spent eating out. And so I'm a little extreme there. I've tried to be a little less worried about that as I've grown my net worth and wealth. But I literally have a full 8.5 by 11 check sheet of all the accounts that I have to reconcile on a monthly basis. So I am on a once a month thing like you are, Kyle. So that was a long answer to it, but I definitely, that's the rhythm that I've gotten as well. So, because I don't want to be so single focused and obsessed with looking at it every day, because guess what? It goes up and down every day.
Cool. Yeah. No, wanted to know, and anyone in chat, if you've got a money rhythm that you think serves you, share it in chat. D Byrd, anything you want to add to that?
I know, Kyle, that you guys also do you have your family code, and you do like your annual planning and your quarterly planning, right? To really build out.
He has a family code.
I'm telling you, you would love it. Yes.
Oh, dude, we got to talk about the code. We got to do another offline call. I'm writing a book called The Savage Code, which is all about having a personal code, and money is part of that, but it's, all aspects of life. And the book is going to be The Savage Code, an operating system to win in life and work. So Kyle, we gotta compare some notes offline here.
I love it. We'll share a little bit of that family banking business in idea number 3 for today. So we'll touch on it briefly, but yeah, I'd love to do that.
Oh, and I see your chat in here, D Byrd. I missed that. Love it.
Well aware.
All right. Well, back on track. Go ahead and share again. Thank you.
Let's do that. So this tough money effect is all around habits. Your habits will affect your wealth plan more than you realize. So the answer to idea number 1, how do my habits affect my wealth plan? You got to build tough money. And the sooner you can start permanently keeping money in your life through habits, the easier everything else becomes, because you just get tougher with that foundation, like Todd said. Now, let's jump quickly into idea number 2. This is what we call the problem. How does banking affect my wealth plan? And I'm going to share one visual with you that I really want this image to just stick with everyone. But there's a book out there. It's the one behind me too. This book was given to me by an orthodontist of all people as a gift. It's less than 100 pages long, but this book identifies a problem that every American is financing everything in life. And what that means is you either borrow money from a financial institution and you pay interest, we're all aware of that, or you were like me growing up, and I was always taught to pay cash. But it wasn't until I met this orthodontist that he said, Kyle, even when you're paying cash, you're giving up the interest you could have earned. So quick calculation, if I go out and buy a $30,000 vehicle, whatever this is, and I could have earned around a 4% return net on that 30 grand over the next 30 years of my life, that $30,000 decision does not cost me 30 grand. It cost me $97,000 to my wealth plan. And the sooner we start recognizing that this happens every time you go to lunch, every time you take a vacation, every time you increase your marketing budget, all of that has an opportunity cost to it. And this book gives some context to that. And so I'd highly recommend everyone pick up a copy. In the KW Wealth community, they had this was mandatory reading for one of their quarterly masterminds. All of us are good at business. All of us are good at investing, but we got to start learning how to think more like bankers. So here's a quick question that I kind of put that initial question into context. Ask yourself, if you added up all the money you earned in the last 10 years, think about that number for a second. So if you've been making $100,000 a year as a loan officer for the last decade, $1 million has flowed through your hands. How much of it could you access and write a check for today? And I love to ask you three, because we teach this all over the country to thousands of people every single year. What do you think the number one answer is as a percentage that people still keep and have access to over the last 10 years?
I think it's less than 10%.
What do you think, Deborah?
I would say less than 5%, honestly. They're in debt.
Dave, where are you at? Same?
Oh, with Deborah.
Okay. Number one answer is 5% or less. Every now and again, you get a few people in the room that are at 10, 15, but those are the Todd Bookspans of the world, right? Those are the ones that have put in the time. They're sharp. They're educated. They take this stuff seriously. He's got his Claude tied into all the tracking metrics. And so I'm still doing all my win by noon with my pen and paper every day. I like the physical. We still use technology, but I'm probably not as sophisticated as Todd. So number one answer is 5% or less. So this goes back to, we are working so hard to develop our skill sets to create new money, but we're not learning how to control it as it's flowing through our life. And this is costing you years off of your wealth planning goals. If we just fix this problem, everything else becomes a little bit easier. So,
and real quick, when you asked that question, it was, what do most people have? Was it? That was the question?
Yep. What's the number one response? Because we use an application called Slido when we teach this live, so we get anonymous data from the room.
Got it. Yeah, no,
Number one piece of data we get for this answer is 5% or less. Every now and again, you see someone that can do 10, 15. If you get some of the stuff down that we're talking about, your number in the future will be 20, 30, 40%. For things you're doing already, we just don't think about this. So this image on the screen right here, how do banks think about money? Now, this rocked my paradigm around money forever when this orthodontist showed me this. So everyone on the call today is an employee, a self-employed individual, a business owner, or an investor. All of us have made money and saved it with some type of banker. We've all been the borrower in our life to finance investments, credit cards, vehicles, whatever it is. And if you look at this, every business owner, investor, employee, all of us are trying to develop our skill sets to create new money. How do I get better at marketing? How do I do more loans this year? How do I serve more families? We obsess around the skill set of getting better, which is great. There's nothing wrong with getting better at creating new money. What the bankers did is they positioned themselves right in the middle of this. They don't really care if you're financing equipment or paying cash for it, because the flow of money always goes through their business one way or another. And the sooner you can recognize this is happening, and you could say, you know what if we just did this for myself? What would this do to my wealth plan? So let me tell you a quick story. That orthodontist, he was teaching a room of 20 millionaire dentists, surgeons, and other orthodontists, and my wife worked for this guy. That's how I figured out, hey, can I come to one of your classes you were teaching after hours about wealth building? So I sat in there as a 24-year-old kid. My wife and I made almost no money. We were in the level 1 category, less than 100,000 of net worth back then. And I'm in this room full of millionaires, which is a good room to be in. And he's saying, right now, all of you guys are financing $80,000 to $100,000 x-ray machines, and you're making someone else really wealthy. Why don't you build your own system to do this for your business as the banker? And I'm like, who talks like this? I don't even know what you just said, but that concept was so intriguing to me. I had to go so much deeper on this, and this is what we teach today as part of our business plan. So if there's one image I want everyone to remember, it's this one right here. There is an entity sitting at the center of all of this, and all banks do is they focus and obsess on controlling money flowing through from every other business owner, investor, and employee. And they are some of the wealthiest companies in the world. So how does this apply to a financial decision all the loan officers on the call are making today? If you think about the idea of just buying vehicles, there's only two real ways we can talk to buy vehicles. You either pay cash for them or you borrow money and you finance them. And the sad reality is whatever decision you choose, you're going to end up with $0 in your control. Because what you're doing as a borrower is you're going into debt, you're borrowing money, you're making payments off, and as soon as that car is paid off, what do people do, Dave? They trade it in for the next one and they repeat the process over again. So what do we do? If your parents were like mine, they said, Kyle, we're not going to pay anyone interest. We're going to save up and pay cash. So we save up some money. We drain that account down to $0. We buy the car. And as I'm driving that car, what do? I save up for the next car. And if we repeat this process over a lifetime, we're in this constant state of wealth interruption. And it doesn't just cost you what the vehicle cost, it costs you what you could have earned if you would have had that money sequenced in a more efficient environment. And so most people for their wealth plan, because they don't understand the world of banking, every financial decision they're making is eating away at their future net worth. Where if you learn this concept, you spend a few hours going through some education on this, eventually the light bulbs go off and you're going to go, oh my gosh, I have missed this for 10, 20, or 30 years of my life. And you can be constantly compounding on much more of your money, but we have to understand this world of banking. So here's some quick numbers. Average American will drive about 13 vehicles in their lifetime, and they're going to spend roughly $400,000 doing that. That's principal and interest. And they're going to end up with $0 in their control. So the question we asked before, how much money has flowed through your hands in the last 10 years of income? Most Americans can access and write a check for about 5% of that. When it comes to vehicles, the answer is 0. And it's not because we're not good at our business or investing. It's because we don't understand this world of banking. Now, if you have the right asset at your foundation and you understand this world of banking, you could take the same $400,000 and you could create well over $1 million of wealth just by taking over this financing ability in your business or your personal life. And so if you apply, and the reason I'm sharing vehicles is everyone drives, everyone has driven. Not everyone owns investments, but when you take this concept and you do what Deborah's doing, what Todd's doing, and you apply this to your business or your investment strategy, like buying real estate, you will supercharge your wealth plan and you'll do it with less risk at the same time. Okay, so very quickly, in a nutshell, that is the idea of banking, which is a conversation around permanent control. So let's wrap up this call with just talking about idea number 3, which I'd say is the toughest asset. What is the foundation of my wealth plan? So there is a certain insurance policy that has more benefits than anything else I have found in the last 10 years. And it is a whole life insurance contract. This is a very specialized type of insurance. And there's a few different types of insurance. You have term insurance, you have permanent insurance. And the policies that I built my wealth foundation on were what's called whole life insurance. So quick lesson on life insurance. There's a few different types out there, very similar to like real estate. You could have commercial real estate, residential, short-term, long-term. There's a lot of different types of real estate you could buy. In my space in the insurance industry, it's going to be similar. Now, where does an asset like life insurance exist in someone's wealth plan? The biggest misconception people have around insurance is they would classify it as an investment. And the product that I put at my foundation, which is the same one banks are buying, by the way, is not called whole life insurance. It's called whole life, or not called whole life investment. It's called whole life insurance. And insurance is a protection vehicle. And so biggest misconception people have when they're learning some of the concepts we teach is that it does not belong in that gold box. It's not an investment. It is a liquid, safe place to store cash. And the reason I'll make the argument for this, after I heard that orthodontist speak about money, I went and bought one of these insurance policies. And I'm coming into the 13th year of owning this insurance policy. Now, back then I was saving $8,000 a year into my first insurance policy. And this very next year, I'm going to pay in, we just paid $8,000 in premium. Every July we do this. And this last year, it grows into $13,000 with no taxes and no risk. That's $1.63 for every dollar I put into that policy. And so you got to remember, this is not an investment, but this is a place where my family now stores our cash or cash reserves. If we go another 15 years, I'm going to put in the same $8,000 of premium. That's called savings. It's going to grow to $24,000 that very next year, or $3.10 for every dollar I put into this. Now, Deborah, you and Todd, you're coming into those years where every time you pay in $1 of premium, it starts to spit out more than $1 net of taxes, completely private. And this is exactly like running a business. The hardest years of your business are probably the first 1, 2, or 3. You look at someone that's been in the business 15 years and you're like, I'd love those results, but nobody wants to go through the first 3 years of pain. That's just the reality, right? And so what's interesting about this policy, there was a gentleman in Keller Williams who was buying insurance the same time I was. The difference was his first policy was $90,000 a year in premium. So 10, 11 times bigger than mine. And nobody taught him how to use this insurance policy as a wealth building tool. He just had it, and thankfully it was set up properly. This guy's paying in $90,000 of premium this year. His policy grows $154,000, or $1.72 for every dollar he puts into it. No risk, no taxes. And so if you look at this as just where am I putting cash right now, this asset, I would make the argument, is the toughest foundational asset you can own. And commercial banks, who are some of the best players in the money game, own more of this asset than anyone else in the United States. Bank of America has $24 billion of what's called cash value on their balance sheets. Not a death benefit, but equity reserves in these insurance contracts. Wells Fargo, Chase, you can see the amount of insurance in cash proportionate they own on their balance sheet. And this is public information. You can go research this. And the reason they like that is because of this slide right here. Banks will offer us commercial products like high yield savings accounts, checking accounts, money markets. And right now, Americans are keeping about $17 trillion in those 3 accounts. They're also the accounts that give you little to no benefits towards your wealth plan. And the further you go towards the left side of the screen, the more benefits you're going to get at the foundation of your wealth plan. So why do banks love this asset so much? Because it's very safe. It's liquid. They get a very high rate of return, very consistent. It's completely private. You can use a flexible loan provision in there. You can use this for retirement. You get a death benefit. It has more benefits built into it than any other singular asset I have found, which is why I'd make the argument that this asset needs to be sequenced properly and built properly for your wealth plan. And, I don't think I'm that smart, but I can follow a system and a model. And if the wealthiest companies in the world are buying more of this than anyone else, why do I not just buy this for myself and then move my money the same way the commercial bank is moving theirs? And that strategy has worked out very well for my family. And so biggest misconception people have is they classify insurance as an investment, and that's why they can never see it. This is also why I think people hate saving money, because the environments Americans are saving money in doesn't really do anything to push your financial path forward. And if you just change where you save money, I have insurance policies that beat a lot of people's real estate properties they're buying. And those are investments. My safety accounts are so efficient at this point, I can be a more patient investor, a more patient business owner. It'll change everything for you. Before we end with like the last 1 or 2 slides, any ideas that are popping up right now based off that last section we just went through? And I know we're moving quick.
Yeah, I think there's 2 things I want to remind you of. The word that Kyle used again is sequence, right? This is planting a tree, right? The best day to plant an elm tree was 20 years ago. The next best day is today. That's why I started this for my grandkid, I've got 3 policies myself. My wife has a policy. And then Kyle said something, he said it a few times, that this isn't an investment. So what happens is you ask someone else who's an investor, like, oh, and they're like, oh, that's just dumb. It only makes 4% a year. Well, that's okay. Most people aren't making 4% a year on all their other things. And the fact that, Kyle, you're putting in, I am definitely envious, dollar put in now, and your original policy is $1.63. Mine are getting good because I've had, one of them now for long enough, but I've added policies since then. And so you have to think about that. And then the other phrase you really need to write down is velocity of money. Because when you go back to the example of the car loans, that's velocity of money. And so when you watch Kyle's other education, which is all free, you'll understand it if you realize that your dollar's making money in more than one place. I use my policy now for private loans. And so I'm still getting paid 4% on the money that's in my policy. That's not that sexy, but it's 4% that is still getting paid velocity of money while someone else is paying me 12% or whatever that I'm charging them for that other money. So I'm making this arbitrage between the two because I put my money years ago into a different savings environment versus if I would loan the money out of my account, then I'm not making that 4%. I would be making 0 because the money's not invested any longer. So was the kind of the blinding flash of the obvious for me and what makes me so excited to be doing this for my grandkid.
That's one of the greatest gifts we can give the next generation, is a really tough foundational asset, something that will not break. It's got to be a policy with guarantees, certainty. And if we can get the next generation to understand how to have a really tough foundation, it'll change the way they get into business, how they go to college, how they serve, how they invest. But most of us have been building wealth with an inverted pyramid. We jump right into investing, and if there's ever an event, there's not a tough enough foundation, and you end up teetering one way or another. And the hard part is you got to be patient and you got to be disciplined. And we live in an age where everyone wants everything right this second.
Yeah, I think that's the key. And so the other thing I would say is, and I don't want to offend any State Farm agents out there or any American Family agents. I mean, the most of the life insurance that's out there isn't built for this. The companies don't want their people doing this, where you work with people who, number one is you and your team structure this the right way. Number two is you actually work with insurance companies that understand this and support it, because in the end, it's the opposite of normally people want to pay the least amount for the most insurance. And this is the opposite. You're actually trying to pay the most amount for the least insurance. That's at least my perception. You can certainly probably correct any inaccuracies in that statement, but it's a special built policy with an expert. And I know you love your current insurance agent. My kids actually own an insurance company, but I didn't use their insurance company. I actually used Kyle and his team to do my policies.
But guys,
Kyle, do you have a way that if people, like there may be 2 different types of people who one day think they have this set up where they have certain accounts and maybe they just want you to, or your team, to spot check and tell us, am I on track? Is this correct or not? And then those who maybe don't have any of this set up, like, is there a number or email or a way for them to get in touch with your team to kind of sniff test out which path they're on?
Yep. And, education is always the key. And it's why I built my courses. We have a Factum Financial YouTube channel. You can check out my personal YouTube channel as well. All the most frequently asked questions are answered in there. But feel free to reach out to me. Like, retirement is not a word I choose to use in my vocabulary anymore, because what I get to teach people on a daily basis is so fulfilling that I'll literally be teaching these models and frameworks until my time is up here, right? And so feel free to reach out to me directly. You can email me at kyle@factumfinancial.com. Todd, you can put my personal cell phone number in the chat too. I'll just say this too, Deborah, is for everyone listening today, do not run out and go buy insurance. Now, if you need death benefit protection, please go do what you need to do just to make sure that you have that piece in place. But the majority of people that are buying this don't have the right model and framework to understand what they're buying, where it exists in their wealth plan. They probably don't have the right carrier, and the relationship with their agent, it's not the right wealth building team member they need. And so a little bit of front-end education, 2 to 3 hours of reading some books, watching some of our videos, will give you a career's worth of education on insurance, and then you'll know exactly what to do. So we do complimentary life insurance reviews as well. We do not charge. We're not a fee-based agency. We get paid the same way a loan officer or a real estate agent would get paid. If we do a really good job serving you, there's going to be a commission generated. But we very intentionally decided not to go the fee-based agency route. So all of my education, like Todd said, is free. Now, if you're a life insurance agent listening to this, we do charge life insurance agents. We'll charge $10,000 for a 1-year subscription to some of our private courses. For the general public, we'll give that to you completely free, especially because you know Dave, Deborah, and Todd on the call today. So
guys, we are rolling in to the final couple minutes here. If you have last minute questions, get those in chat. If you've got value from this, let us know. Use those little reactions down below. Make sure that you follow this YouTube channel. And Todd, wherever you're listening to this, give it a like, subscribe to it. Todd, as I think people can tell, he is dedicated to the success, the sustainable success of mortgage real estate professionals and turning them into advisors that can help consumers achieve homeownership younger and faster through First Home IQ, and then homeownership, and then financial freedom with homeownership. So Todd, I love that you invited Kyle to this session. And Kyle, it's great to meet with you. I want to learn more about that family code. Give me a high level description of what is your family code.
So yeah, our family code we basically wrote what's called a future family letter, and our code is in that letter. Some people call this a family constitution, but it is a series of beliefs around these 5 areas of life and what we believe in, how we operate as a family, things we tolerate, things we don't tolerate. And you know, we've separated ourselves, and I come from a very middle income family, Dave. Like my dad grew up very, very poor. He worked so hard to get us to that next level. And where my younger brother and I are taking the entire family now is we're moving into becoming a very wealthy family as a unit. And that's going to require a change of discipline, standards, beliefs. And so we wrote this letter because at the end of the day, it won't matter how much wealth you transfer if the family's not prepared for the money. You see this over and over across the world, but then there's families that you can study like the Rockefellers that are 6, 7 generations deep with their wealth. And it's because they had a code or systems of beliefs, systems and processes that transferred with the money. And my belief is we need more good people in this world with a lot of resources. And we can take that conversation a number of different ways. Combating evil, doing more good. Money is an amplifier and a resource at the end of the day. And I think more good people need as much of it as they can possibly handle.
Love that. Do you share that code with anyone? I mean, is that like a personal thing?
I'll send you a copy of our future family letter.
Oh,
and I've got a couple of videos I'll send you too on the family banking business. It's become a very spiritual conversation for our family, Dave, which is an interesting term to throw into a concept like money. Money has become a very spiritual conversation in the Fuller household. We'll put it that way.
I can't wait to read your letter. I'll share my code. You know, it's a longer conversation as to why I wrote it, when I wrote it. I did early, it was one of the best things I ever did with my kids is we wrote the Savage family mission, values, and that's part of the code. But I did that when my second child was about 6 months old, maybe 4 months old. Anyways, Kyle, you've been amazing. Really appreciate you, brother.
The pleasure
I
is
want to
all
hang
mine.
out too. I know Kyle's got 2 more slides, so I apologize to everyone. We're going to run late.
I'm sorry, I didn't know that.
If you guys have to jump, but we'll make sure the recordings will be posted early next week. So if you're here live and going to miss out, but I feel like Kyle, we should probably show those last 2 slides, and as long as you have time and don't have to jump, I would love to spend a few extra minutes if you're good with that.
So if we wrap all of these ideas together, idea number 1, the inconvenient truth. How do my habits affect my wealth plan? You got to have tough money habits. Idea number 2, the problem. How does banking affect my wealth plan? We need to study this world of banking, how to permanently control dollars in our life. And idea number 3, the toughest asset. What is the foundation of my wealth plan? I think whole life insurance is the toughest foundational asset you can own. And when you put all of these ideas together and you apply it, Dave, at like a family level, this is what we call the family banking business. Now, this is a leadership conversation. So let's assume we got a family with 3 young kiddos, and we're starting to get intentional about this wealth plan. Well, as those kids grow from being a dependent state on mom and dad, they grow into this independent state. And when this happens in our society, this is usually a very proud moment. The kids grow up, they move out of the home, they move away from mom and dad. And like all of these wealth decisions just leave mom and dad in generation one. And what I don't like about what happens typically here is financial institutions will move in to create those relationships with money around our kids. Now, I don't really believe that Chase Bank has the best motives for my children in their life. And the reality is, all of our kids are going to grow up and buy vehicles and drive vehicles. Now, from the math we talked about earlier, every one of my kids, and I got 4 little ones right now, Dave, every one of my kids will spend roughly $400,000 on vehicles over their lifetime. If we had that sequenced properly in the right assets, like Todd was talking about, it's $1.5 million opportunity cost for every child just to drive vehicles. So you got a family of 3, it's a $4.5 million wealth plan that just walks out of your family's legacy. And it goes right to these big banks. They control this flow of money now. And so I was not okay with this, and I want relationships with my kids. So what we built is this model to work interdependently with my children in the future. And so my kids all know we have this private banking entity that we own and control. So when they need to finance things in their life, like vehicles, they don't walk over to Chase Bank. They come to my wife, Diane, and I, and we're going to loan them the money from our family banking business. They will pay it back with principal and interest. And all of this is future cash flow for generation one. Now, when my wife and I pass away, there's this enormous death benefit that's been building the whole time. And the way we structured it in our trust is every child that borrowed money from the family bank, when we pass away, they get reimbursed 100% principal and interest for those transactions they made before the estate plan is split. So imagine if Chase Bank or Bank of America said, Dave, if you use us exclusively for the next 30 years, we're going to write you a check, income tax-free, for 100% of the money you borrowed and paid back to our commercial bank. We just wanted to thank you for helping us become so wealthy. Now, if a bank offered you that, you would never walk into another commercial bank. They would have your loyalty for life. And I'm interested in building lifelong relationships, especially with my children. So not only do I get the chance to teach them about money, I get to steward them. I want as much of my leadership principles and my values transferring with my kids along with the money. Now, if I can do that properly, my intent is by the time my kids are 20, 25, I want them to be as prepared for life as they can possibly be. And there's a really good book that I've been loving. I've been through it 5 times already. It's called The Intentional Father. And a lot of it is like helping us understand how to raise the next generation so that they become good at being a man or a woman, not just being a good man or a good woman, but you become good at that activity. And so this has become a very spiritual conversation for our family. Now, you could take a business owner and you could apply this to employees, business equipment, real estate investing. The principle is the same. And that's what we'd love to talk to everyone on the call today about is if you got questions about your unique strategy, let's help you build this blueprint and apply it to whatever strategy is giving you the most energy and excitement and fulfillment.
Yeah, I just love it. This interdependent thing as a parent, I feel like is why I'm so passionate about First Home IQ is I feel like I could have done a better job with my kids. I did a pretty good job, but I could have done a great job. And I think you're doing a great job in setting a leadership example. And so think about it, everyone. Kyle talks about this thing with the vehicles. He also told you that his 8-year-old in 2 years, when he's 10, will be able to buy his first investment property. Guess what? He's not going to he's getting the down payment or maybe even the full amount from his banking system that he created. They may use us for that type of, for a first lien and do a second lien from their own monies. But that's why Keller Williams has brought it in is they really want their agents to be the wealthiest agents in the world, not just the best real estate agents, but they want them to be wealthy. And so I would just encourage you to think through what you just heard because it's probably different. You probably have your own perceptions and misconceptions, or maybe it's what you believe with regards to this and this safety place to store your money. It's the foundation of my finances going forward because it's what I'm using for velocity of money. It's what I'm using for my safety, where I'm storing my money safely because I'm not worried about a 100-year-old mutual insurance company going out of business. And I'm super grateful, Dave. What kind of questions do you have here in closing? I'm glad you were able to hang out and hear the rest of it.
Yeah, just really impressed. A lot to think about. I know we're over, so I'm not going to go too on, but I think this was a great lesson for everyone. I hope you got a lot of value from it.
Thanks for having me, gentlemen. It's an absolute pleasure.
Well, I would just encourage y'all, if you want to learn more, reach out to Kyle. We'll have his contact info. If you're here live, I put his cell phone number at his request in the chat. We'll make sure you guys have it on YouTube and also on the podcast formats. But the bottom line is this, is that there is a difference in how this strategy is executed. So I would encourage you guys to look maybe for an expert versus a current friend who may not be an expert. Kyle, so grateful for you. Appreciate all of your mentorship, leadership, especially in this area, and can't wait to get feedback on. I feel like we'll have to do a part 2 to this just because I know we ran tight on time, but I know it'll be great. We will see you on the next episode of the Loan Officer Mastermind. Thanks, everyone. Thanks, Kyle.
Take care.
Thank you.